The world woke up to a seismic shock in global geopolitics and financial markets, not because of slow-burn political maneuvering, but due to a direct, public ultimatum from U.S. President Donald Trump aimed squarely at Iran's leadership, warning that Tehran must agree to a new nuclear deal or face consequences far worse than any it has yet endured. This isn't anonymous diplomatic cable language buried in government channels. It's a blunt public declaration that instantly strained global risk appetite and sent deep ripples through equity, commodity, and bond markets. On February 17, 2026, in the midst of high-stakes indirect nuclear negotiations in Geneva, mediated by Oman, Trump confirmed that he would be indirectly involved in talks with Iran, a rare and strategic public intervention that threw an enormous psychological wildcard into markets already on edge. The backdrop to this moment is an Iran that, after months of internal unrest, mounting economic pressure, and stalled diplomatic processes, is refusing to yield ground on issues like uranium enrichment, leaving global investors to price in potential conflict outcomes instead of stable diplomatic resolution. Almost immediately, global markets shifted into risk-off mode. In Asia on February 17, major stock exchanges either closed for Lunar New Year or opened with caution, with indicators like Japan's Nikkei down and U.S. futures pointing lower before open, a direct reflection of war risk discounting rather than fundamentals like earnings or macro data. Safe haven assets like government bonds strengthened, while equities and commodities responded not to economic signals but to geopolitical uncertainty. One of the most telling reactions came from oil markets, the first real barometer of how financial systems price conflict risk. In the hours and days following Trump's ultimatum and ahead of renewed talks, Brent crude and WTI futures both climbed. Crude rose as traders braced for potential supply disruption at the very choke point that carries roughly 20% of the world's oil exports, the Strait of Hormuz. The atmosphere in energy markets was less about supply fundamentals and more about war premia. Traders hoisted prices to factor in instability, not sales demand. These price moves matter in a way few realize. Crude oil isn't just a fuel commodity. It is a proxy for global risk. When prices jump sharply on geopolitical headlines alone, it signals that investors are no longer pricing broad economic growth or corporate cash flows, but the fear of disruption, possibly protracted conflict, and the collapse of stable trade. A small bump from $60 to near $70 a barrel, as seen in recent sessions, reflects markets elevating risk premiums because the threat of conflict is no longer theoretical. And this shock isn't confined to energy markets. Equities around the world, already jittery from other macro pressures, have been exhibiting heightened volatility as geopolitical headlines become the dominant driver of daily price swings. The classic metrics of economic performance, earnings, interest rates, inflation data have been overshadowed by the question now at the heart of market psychology: could this confrontation between the U.S. and Iran actually escalate into military conflict? And if so, what would that do to global trade, supply chains, risk assets, and investment confidence? This moment, breaking out into the open now, is extraordinary precisely because it combines the highest level of geopolitical threat with real economic transmission channels, energy prices, risk premiums, bond yields, and stock volatility. Investors are not just watching headlines anymore, they are pricing them into every asset class. Whether markets rise or fall from here depends less on growth forecasts or corporate earnings than on whether the world avoids an escalation that could push oil prices far higher and inject a persistent risk premium into global finance. In short, Trump's ultimatum to Iran did more than threaten diplomatic failure. It rewired how global markets think about geopolitical risk. The crisis we're watching today didn't appear out of thin air. It is the product of years of failed diplomacy, strategic miscalculations, economic collapses, and geopolitical leverage that markets priced until only now. At the surface level, President Donald Trump's blunt public ultimatum negotiate a nuclear deal or face consequences far worse than any previous attack feels like a sudden shock. But beneath that headline is a series of structural pressures and strategic deadlocks that made this escalation almost inevitable and that markets are only just beginning to fully understand. The origins of this standoff trace back not to the most recent statements but to long-standing mistrust between Washington and Tehran, compounded by internal turmoil inside Iran that has left its leadership both weakened and unpredictable. Over the past year, Iran's rial collapsed to record lows, with the currency trading at unprecedented rates against the dollar and contributing to inflation that exceeded 40%, a collapse that fueled widespread protests and political instability across urban centers. This economic desperation has made Iran simultaneously more vulnerable and more defiant, creating a regime that cannot easily concede on core strategic issues like uranium enrichment without risking internal legitimacy. What markets are only now pricing in is the cumulative effect of this dynamic, an Iranian leadership under pressure at home, yet unwilling to give ground on its nuclear program, and a U.S. leadership publicly signaling both military pressure and diplomatic engagement with equal intensity. On February 17, 2026, as indirect nuclear talks resumed in Geneva, mediated by Oman, the U.S. delegation, including senior envoys, faced a stark reality. Iran will not abandon key elements of its nuclear program unless it sees credible sanctions relief and economic incentives, something the Trump administration has been reluctant to offer publicly. Complicating the picture is the duality of U.S. strategy. Trump has made public comments that signal a hardline military posture while simultaneously endorsing diplomatic talks that technically aim to avert conflict. Markets hate dual signals because they imply uncertainty and asymmetric outcomes, or even a slight misstep could flip a diplomatic process into a shooting war. That uncertainty has been priced into asset markets, not just crude oil, but equities and safe haven instruments like gold, because traders now realize they are not dealing with a standard negotiation, but a geopolitical game of chicken with far higher stakes. A key hidden truth that has only recently surfaced in investor psychology is how strategic posturing has replaced coherent negotiation. For months, markets were comforted by intermittent signs of de-escalation, rallies in Gulf bourses when Trump said Iran was seriously talking with the U.S., and dips in oil prices when diplomatic channels appeared to open. But these temporary relief rallies proved deceptive because they ignored the deeper strategic gridlock. Iran's core demands revolve around sanctions relief tied explicitly to nuclear concessions. And Tehran has been publicly clear that it will not negotiate other matters, such as its missile program or regional influence, as part of the nuclear deal. What investors are waking up to now is that diplomacy is fragile and contingent on mutual concessions that neither side is fully prepared to grant. Iran's naval drills in the Strait of Hormuz, a vital choke point for almost 20% of global oil exports, conducted just as talks were set to begin, are not random acts. They are strategic levers meant to signal that Tehran can disrupt global energy supplies if pressures cross certain thresholds. Markets interpret such signaling not as negotiation tactics but as embedded escalation risk. Meanwhile, the U.S. military has maintained and even expanded its presence in the region, with warships and carrier strike groups deployed as both deterrence and leverage. Reuters reports that U.S. preparations for possible operations have investors pricing in weeks-long contingency scenarios rather than a quick diplomatic resolution. This dynamic changes the narrative. What began as diplomatic engagement has become a dual-track strategy of pressure and negotiation, and markets are notoriously sensitive to the pressure track. In essence, the hidden truth is that this crisis is not a single event but the result of systemic failures on both sides. Tehran's inability to bridge economic desperation and strategic demands, and Washington's failure to present a consistent, credible framework for negotiation that markets can trust. As a result, what investors are now pricing and what most mainstream narratives have overlooked until the latest data is a geopolitical risk premium that could persist or even intensify if the structural impasses are not resolved soon. In a world already grappling with fragile economic growth, persistent inflation pressures, and central banks walking a tightrope between raising and cutting interest rates, the latest geopolitical shock around the U.S.-Iran confrontation has begun to bleed into everyday financial life in ways most global headlines still barely acknowledge. The unfolding narrative is not just markets moving. It's millions of investors, workers, and consumers feeling the shockwaves in portfolios, fuel prices, savings, and business plans, and the latest 2026 data make it clear that this isn't a distant geopolitical story anymore, but one that's reshaping the global economy right now. The first major and undeniable impact is in global equity markets, where risk-off sentiment has taken the stage. On February 16, 2026, most stock indexes in the Gulf region, one of the world's most oil-sensitive and geopolitically exposed markets, fell sharply as investors weighed the looming U.S.-Iran nuclear talks in Geneva and the possibility that failure could lead to direct conflict. Benchmarks like Saudi Arabia's Tadawul dropped around 0.4%, while indices in Dubai, Abu Dhabi, and Qatar all declined, pulling down major financial and energy firms that underpin household pensions, sovereign wealth funds, and retirement accounts throughout the Middle East. But this is just the tip of the iceberg. Asian markets, traditionally viewed as engines of global growth, opened cautiously weaker on February 17, 2026, ahead of the U.S.-Iran talks. Japan's Nikkei slid nearly 1%, while broader regional sentiment was subdued in holiday-thin trading, a reflection of investor nerves rather than normal economic uncertainty. U.S. futures pointed lower, underscoring that the fear today is geopolitical risk and economic disruption, not cyclic slowing. Energy markets, which truly bridge geopolitical risk with daily economic reality, have been a battleground of volatility. Oil prices have been unusually unstable, climbing on fears of supply disruption tied to tension in the Strait of Hormuz, the vital maritime choke point through which roughly a fifth of the world's oil supply passes. On February 16-17, Brent crude futures were nudged higher as traders priced in the uncertainty around U.S.-Iran negotiations, while West Texas Intermediate likewise gained, even as some sessions saw dips based on shifting headlines about diplomacy versus confrontation. The price of oil matters beyond traders. Fuel underpins transportation costs, food distribution, manufacturing, and inflation expectations worldwide. Even a modest upward shift in crude, from a range in the low $60s toward $70 per barrel, tangibly increases costs for trucking, airlines, marine freight, and agriculture. These added costs quickly filter into consumer prices for goods and services, squeezing household budgets already stretched by broader inflation pressure. Simultaneously, precious metals, another classic economic barometer, have seen sharp swings. Gold, traditionally a safe haven asset, slid over 2% recently because of a firmer U.S. dollar and thin trading conditions, even as geopolitical tensions persisted. A stronger dollar makes dollar-priced gold less attractive for holders of other currencies, but that volatility itself is a symptom of market stress. Investors are simultaneously seeking shelter and reacting to liquidity distortions. Across financial markets, the impact is unequivocal. Investors are de-risking portfolios, selling riskier equities, and reallocating into government bonds, safe currencies, and short-term instruments. This behavior doesn't just shift asset prices, it raises the cost of capital for companies looking to borrow or invest, slows corporate expansion, and feeds into slower global economic growth forecasts. Entire sectors tied to energy, trade, and financial services are recalibrating expectations around growth and earnings as geopolitical risk premiums are baked into valuations. Beyond numbers, there's a human element that often goes unmentioned in financial summaries. When markets negatively react, pension funds lose value, job-creating capital gets delayed, and business investment decisions are postponed. Consumers tighten spending in the face of rising fuel costs and uncertain job prospects, which in turn reduces retail revenues, slows service sector growth, and pressures governments already stretched by post-pandemic fiscal constraints. This feedback loop from geopolitical threat to market panic to economic slowdown is already in motion. While policymakers and diplomats grapple with nuclear negotiations and military signaling, ordinary people are beginning to feel the fallout in their wallets, their retirements, and the price they pay at the pump, and unless a breakthrough emerges in talks or tensions to escalate rapidly, these financial and economic shocks are likely to deepen, not dissipate. To understand the current shockwaves rolling through global markets and everyday economies, we must look beyond headlines about rising oil prices or volatile stock indexes and confront decision makers and actions that have made this crisis far worse than it needed to be. This is not a situation where events simply spun out of control by accident. There are clear patterns of contentious choices, strategic misalignment, and public rhetoric that directly fueled market fear and geopolitical instability. At the center of this narrative stands U.S. President Donald Trump, whose public ultimatum to Iran that Tehran must agree to a nuclear deal or face consequences far worse than previous attacks was unprecedented in tone and substance. It was not delivered in private diplomatic channels or backroom negotiations. It was stated publicly, amplified across global media outlets, and interpreted by markets as a credible threat of military escalation. The bluntness of this rhetoric created a novel risk premium that traditional market models simply weren't prepared for. This is not a minor misstep. It is the kind of message that forces oil traders, sovereign wealth funds, and central banks to rethink risk allocations in real time. Reuters. Calm foreign policy experts and senior diplomats have expressed concern internally that such public statements risk undermining the delicate negotiation dynamics in Geneva, where indirect talks between U.S. representatives and Iranian officials resumed in mid-February 2026 under Omani mediation. Diplomacy requires credible incentives, not just threats, and the apparent lack of a clear negotiating framework from the U.S. side, as reflected in public statements, has reduced Tehran's incentive to make concessions. Instead, Iran has responded by reinforcing its red lines, maintaining advanced uranium enrichment capabilities, and refusing to negotiate on regional defense programs that it considers essential to national sovereignty. This diplomatic gridlock is now directly reflected in market pricing, animating volatility and uncertainty risk premiums. News. Meanwhile, Iran's leadership itself shares responsibility for the escalation dynamics. Rather than engaging in full-scale cooperation with international nuclear inspectors and accepting negotiated limits on sensitive enrichment activity, Tehran has taken steps that appear designed to sustain leverage, including continued missile tests and naval maneuvers in the Strait of Hormuz, the strategic choke point through which nearly 20% of global oil shipments transit. These moves did not happen in isolation. They occurred as talks were set to begin, signaling Iran's unwillingness to separate nuclear negotiations from broader geopolitical demands. Markets interpret such signaling not just as negotiation tactics, but as embedded escalation risk and price assets accordingly. The result, oil futures move higher, currencies of oil importing economies weaken, and equities discount slower growth. In Wikipedia.org, the regional context adds another layer of accountability. Gulf Cooperation Council countries, particularly Saudi Arabia and the United Arab Emirates, have increased defense posturing and warning signals over recent months. Their strategic alignment with U.S. security policies, especially heightened surveillance and joint military drills, has escalated regional tension, not eased it. Rather than serving as stabilizers, these actions have reinforced the perception of an imminent security crisis, encouraging markets to price in premature worst-case scenarios rather than measured conflict risk. The very actors who fear instability have contributed to it by adopting defensive postures that markets misread as precursors to open conflict. Critics have pointed to the lack of clear risk communication from Western policy circles as a grave error. Central bankers, finance ministers, and treasury secretaries were caught off guard by the immediate market reactions, which now require emergency risk meetings in London, New York, and Tokyo to reassess debt forecasts and portfolio allocations. More than once in the past week, central bank officials have privately acknowledged that geopolitical risk pricing has overwhelmed economic fundamentals, meaning that markets are reacting not to growth data or earnings results, but to the probability of conflict escalation. This suggests a failure not just of foreign policy messaging, but of economic risk forecasting systems that are meant to absorb shocks without systemic panic. Meanwhile, hardline factions within Iran, including elements of the Islamic Revolutionary Guard Corps, IRG, have publicly issued statements implying that Tehran would escalate proxy responses should direct pressure intensify, effectively making negotiations asymmetric. In markets, asymmetric risk is the most destabilizing kind, because it means potential outcomes are not capped at diplomatic failure, but could include regional military escalation, supply chain disruption, and transmission into broader commodity markets. In essence, the reality markets are pricing today is not simply tension between two states, but a series of contested decisions, public ultimatums, strategic posturing, mixed diplomatic signals, and reactive defense alignments that have collectively created an environment where fear drives pricing more than economic data. The question investors are now asking is no longer what will inflation be next quarter, but could we be facing a geopolitical shock that dwarfs the economic ones we've lived through in recent years? And that uncertainty, nurtured by decision makers on all sides, is the real driver of the crisis we see unfolding. What markets are pricing right now isn't just about a single data release or corporate earnings beat. It's a global risk premium being built into every asset class because financial systems now view U.S.-Iran geopolitical dynamics as a potential structural shock to global economic architecture. Traders, policymakers, and economists are confronting a future where energy prices, inflation expectations, trade flows, and sovereign bond yields could all permanently reset depending on how the next few weeks unfold. The most vivid indicator of this future shock is energy markets. As talks between Washington and Tehran resumed in Geneva this week, oil benchmarks, Brent crude and West Texas Intermediate, have been hovering near 6-month highs, supported less by traditional supply-demand fundamentals and more by risk pricing tied to geopolitical uncertainty. While Brent prices are modestly stable around the high $60s per barrel range, analysts from firms like Citi are warning that if current tensions persist without meaningful diplomatic progress, oil prices are likely to remain elevated or rise further due to persistent geopolitical supply concerns. That would feed straight into global inflation, especially in energy-dependent economies. This pricing dynamic matters far beyond traders' screens because oil is a cost input for practically every sector of the global economy: transportation, agriculture, manufacturing, even digital infrastructure. Elevated energy prices filter into production costs, consumer prices, and ultimately wage demands. For emerging markets already battling inflation and currency stress, this could translate into stagflation-like conditions where growth slows just as prices rise, squeezing living standards and government budgets simultaneously. At the same time, financial markets are reacting with renewed risk aversion. On February 16, major Gulf equities declined sharply amid caution ahead of the U.S. Iran talks, underscoring that even markets closer to the geopolitical epicenter are not immune from panic-driven flows. Stocks in Saudi Arabia, Dubai, Abu Dhabi, and Qatar fell as investors reduced exposure to risk assets and rotated into perceived safe havens. This pattern risk-off drives higher government bond demand, lower corporate credit issuance, and potentially tighter financial conditions worldwide if it persists. Central bankers and fiscal authorities are now in a difficult bind. Before the current escalation, many were already watching inflation and growth data for the next cues on interest rate policy. Now, geopolitical risk has become a primary driver in macroeconomic decision-making, forcing policymakers to weigh conflict risk alongside inflation trends. If energy prices continue to climb on geopolitical fear alone, central banks may be pressured to tighten monetary policy further, even in economies where growth is weakening, just to keep inflation expectations anchored. That paradox, weaker growth plus higher rates, is exactly the recipe for economic recession. This structural shock also extends to global supply chains and shipping routes. The strategic Strait of Hormuz, which carries roughly 1/5 of the world's oil shipments, remains a persistent flashpoint. When markets see naval exercises or warnings to shipping firms about credible threats near Hormuz, they don't treat these as local risks, they treat them as global infrastructure vulnerabilities that can immediately ripple into everything from freight costs to insurance premiums for maritime transport. Analysts are already warning that any real disruption here could push oil above historically inflationary levels, dragging in both developed and developing economies into a deeper cost shock. On the geopolitical front, experts warn that this isn't a short-lived flash of tension that the market will quickly forget. The Iranian economic crisis itself, with rampant inflation, currency collapse, and rising poverty, creates internal pressure on Tehran's government to resist concessions that would be seen domestically as weakening the state. This means that Iran may double down on strategic leverage rather than concede on nuclear or regional influence issues unless it gets genuine economic relief. That tangled future where politics, economics, and public sentiment intersect is why markets today can't see a clear path forward. Even if a diplomatic breakthrough occurs and sanctions are eased, the long-term volatility premium in markets could remain elevated because traders will remember how rapidly and violently prices reacted to geopolitical headlines. If instead the talks fail and tensions escalate, risk assets could face another severe sell-off, oil could spike well above current levels, and inflation expectations could rise sharply, pushing ordinary consumers and businesses into a cost spiral that central banks find hard to control. In short, there's no simple return to normal until some combination of credible diplomacy, reduced regional tensions, and stable global energy supply dynamics emerges. And because this crisis touches energy security, financial stability, and geopolitical realignment simultaneously, its future impact isn't just a matter of market moves during trading hours, it's a structural shift in how the global economy functions day to day.